Hello and welcome to this financial planning case study on receiving an inheritance. So my name is Dan Woodruff and I'm the founder of Woodruff Financial Planning, and what I'm going to do with this case study is take you quite quickly through an example of how we can help somebody who's about to or has just received an inheritance through the financial planning process. So obviously it's not a full run through of exactly what would happen with a financial plan, but it will give you the gist as to what to expect in that kind of situation. So very quickly, what we're trying to do with the financial plan is give you some clarity about the future. Ultimately, what most people care about is, do they have enough money to live the rest of their life and never run out of money? And once they know that information, they will then be more comfortable to start spending their money on improving their lifestyle in some way. And of course, inheritance fits into this quite nicely in the sense that it is an opportunity to make some changes for the better in their finances. Now, when we get some focus on the action that you can take in your finances, we can start to test alternative scenarios. So what I'm going to take you through 3 alternative scenarios in this inheritance example to show you the ways that your finances could go if you receive a sizable amount in an inheritance. The other thing we do that I'm not going to show you in this review is show you disaster planning. So what happens if a partner dies, gets too ill to work, needs care, go into a care home, or perhaps the stock market crashes. Those kind of unknown variables that would potentially stop you from making decisions in the future. The financial planning process can actually map those out for you too. Now, unfortunately, there are some weaknesses in this approach, and there's 2. We can't predict the future, and the future is not linear. So the financial plan will assume that there's a certain growth rate, there's a certain inflation rate, that your expenses change in a certain way. And of course, that doesn't happen in a linear way like that. So what you need to do is stress test the assumptions we make and make cautious assumptions about the future. Ultimately, you've got to review as your life changes. Now, I'm not going to do that in this review, but at least bear that in mind when we take you through. So I'm going to look at Mr. and Mrs. Inheritance, and they've just received an inheritance of £500,000. So it sounds like a lot of money, but actually it's not unusual in this day and age, because of course if you've got an elderly relative who lived in a house without a mortgage, that could be at least £300,000 quite easily, and potentially a lot more in many circumstances. And with what I tend to find with inheritance situations is it comes with 2 main issues. The first one is responsibility over the money. Ultimately, that's come from a cherished relative like a parent, and that's probably their life savings. So you're not going to make decisions quickly and frivolously in many cases. You're going to want to make sure that you're doing the right thing by that money. But of course, a significant amount of money like this is an opportunity to make changes for the future. So this is where the planning process can help, because it can help you to start to look at the different options available to you and start to be creative in thinking about what's the best way forward, and ultimately not making mistakes with those choices. So, the scenario I'm going to take you through is a very typical situation that we come across. A couple in their early 60s. They've received a large lump of money, but they've already been doing things to prepare for their future. So they've got some pensions, they've got some income already, they're not yet retired, but they've still got a mortgage. So they're thinking about how this lump of money can change their future. Can they afford to retire now or in the future when they had originally planned to? Should they pay off their mortgage, or should they invest the money? And often people come to me with these kind of questions, and we can help to map out those decisions. Really what they're really interested in is will they ever run out of money? So I'm going to switch to our financial planning software to show you my example scenario. So bear in mind, this is not a full financial plan, and we haven't inputted every single bit of information that we would do with a real situation, and of course your situation will be very different to this. So we can cope with any different scenario that you want to throw at us, but I'm going to take you through how this might work in this situation. So we've got Jane and John. They've both got personal pensions in place here. They've been saving towards their future. They've currently got £500,000 from the inheritance just sat in a bank account, and they've done some sensible tax planning over the years. They've been saving into cash ISAs, both of them. you'd be surprised how often we see that people don't use their ISA allowance, but in this case they've got cash ISAs, so these are just bank accounts with a tax-free wrapper around them. And then they've got an investment portfolio that they've been building up some savings over the years in a taxable account. So, they're sat on quite a nice amount of flexible assets here, and this blue section is reflected in the top right hand corner here. So about 2/3 of their money is in flexible assets that could be cashed in tomorrow and spent on a new house or a fancy holiday or a new car, whatever their interests may be. Now they run a business, so they're getting income from that business, but they're thinking about the day when they might retire. Perhaps they might sell the business, perhaps they might just walk away at some point in the future. And like many people, they haven't quite paid off their mortgage yet, so they live in a nice house. It's valued at £400,000, but they've still got a mortgage on that property that's due to be repaid in the next few years. So they've got a buy-to-let property which generates them some income. So what do we do with a financial plan? Well, we make assumptions about the future based on the type of assets that you have, the type of expenses you have, the type of income and so on. And so you can see that reflected in this chart in the bottom right hand corner here. So what that is doing is taking out inflation and showing you the growth rate, the growth progression that we're assuming based on the type of asset that they're invested in over time. And we're working forward to age 100 in this scenario. So you may think, well, the average person lives to about 86, 88, but of course you may not be average. So we tend to err on the side of caution and project further into the future, because basically we don't want to get to the average age and find that you've run out of money. We want to look further than that to give you more security in the future. And what this chart is showing is a couple of things. It's showing that there's a general increase in the asset value over time. But if you look at the black line here, that is showing the net worth. And what that is doing is taking away from the asset growth the way that our software is assuming that their expenses will eat into their assets over time. So you can see here on the left hand side, currently they have a mortgage, so small in relation to their overall net worth, and that's gradually reducing down until the day it's paid off at this point in the future. But you can see in the future that they're going to start to generate some debt, and what that is the system saying, well, if my income is not enough to pay my expenses, what am I going to do with that? Well, I'm going to put it into a nominal bank account with an overdraft, and we're going to deduct the nominal overdraft from the assets, and the net result is the black line we've got here. So while this has given us some interesting information here, it's not telling us the whole story. The next step with this couple is we would need to look at their income. So this is their current situation. Now we can project that forward for the rest of their life. So currently they've got, as most business people would do, they've got a small salary plus dividend income from their business. But interestingly, they've got other income coming in. So they've got income from their buy-to-let property plus investment income that is reinvested. So while it's reinvested, it's actually still taxable, which is why we include it in this analysis. And as they're paying into their pensions currently, that's taken into account. Now I could show you a lot more detail, but I'm not going to do in this short run through. But we would, with a real client, we would go through in ways of helping them to realise how they might better save tax. But here in the bottom right hand corner is what we're particularly interested in, which is how their income is going to change over time. So you can see that at the moment they're generating a nice level of income there. At age 65, they're planning to sell their business and access pension income. So you can see there's a big increase in income for that tax year, and then we're dropping down to much lower levels of income based on their current level of income, and that's happening for the rest of their life. So this will be state pension and private pensions and things like that. So what they need to do is work out whether that's going to be enough to live the life that they're used to at this stage of their life. So the way we do that is we start to look at their expenses. So I've got a brief breakdown of their expenses here. With a real customer, we would go through in a lot more detail than this, but we're just doing this for illustration purposes. So we'd break that down into where the expenditure is coming from. But here we can see how we're projecting that their expenses will change over time. So they're relatively high at the moment, but they're going to reduce down in the next few years when they retire. And then overlaid with that, we've got their projected income with the black line. So you can clearly see that if we show you the difference between the two, they're basically wiping their feet with their income and expenditure at the moment, but the red line shows a deficit between their income and expenditure in the future. Now, it's not anything to panic about, because you can use the capital that they've generated and have saved to access to spend on their lifestyle, either to generate an income from that or to actually just dip into the savings to supplement their lifestyle. And many people do that. So the way we help them to make decisions is we put that money, all of this information, put it all together in what's called a lifetime cash flow forecast. And basically what that does is looks forward into the future, tax year by tax year. The blue in this chart is their income, the red in this chart is their expenditure. And you can see that until they retire, it's roughly the same. That's not unusual. People tend to spend what they earn. Then we're going to sell the business. We're going to access some tax-free cash in their pensions, and then in the future you can see there is a deficit in their income versus their expenditure for the rest of their life. Well, while that's useful and slightly worrying at the moment, what we can see is more useful is when we put that together, looking at their capital. So already they've got money in there. So this is basically looking at their accessible cash, not including their house. From a financial planning perspective, while you could downsize your house in the future, that's not always desirable. So we look at your accessible, flexible assets like your ISAs, your bank accounts, and your pensions. And what we can see is once we take into account future income and expenditure, actually this Mr. and Mrs. Inheritance are going to start to gradually reduce their money down if they don't do something with that. So, okay, they're going to run out of money at age 88. So that's not the end of the world, but of course it could be concerning when you reach 86, that you're shortly going to run out of money in the next few years. And if something dramatic happened in the future, like the need to go into care, well, they probably wouldn't have enough money to pay for that. And if they live a longer life, then they're going to be in significant trouble and having to cut back on their lifestyle expectations. So, well, we've got this opportunity, we've got this inheritance, so we can now start to look at alternative scenarios. So what I've done is I've created two separate scenarios. The first one is what happens if I pay off the mortgage and invest the rest of my proceeds from the inheritance. So remember, their mortgage was 140,000 or so. We could use money from the inheritance. Would be a very sensible thing to do. Clear off your debt, reduce your expenditure as a result, because you won't have to pay the mortgage costs, and it gives you some security in the future. So so the other thing we've done is we've rearranged their ISAs and their investment accounts, plus invested some of the proceeds from their inheritance, kept an emergency fund put aside for emergencies, and basically made the rest of that money work harder for them. So let's overlay that scenario with the current one. So you've got the dotted black line, which is their current position, and you've got the blue section with the sort of lighter colour dotted line, which is paying off the mortgage and investing and rearranging the investments to have capital growth for the future. And you can clearly see there's a massive difference between the two. Basically, we're predicting that if they do some sensible financial planning, that they won't run out of money. Interestingly, people often say to me, okay, well mortgage rates are fairly low at the moment. What if I was to invest that money and make that grow faster? Well, that comes with some risk, because, of course, if you pay for your mortgage, that's a guaranteed return on your money and you've got guaranteed security. But potentially you could make more money by investing that. Of course, you could lose money with investing, because all investing comes with risk to your capital. So let's overlay a separate scenario where we carry on paying to the mortgage but invest all of your money and rearrange that for your benefit. Well, the sort of purpley dotted line shows an even better scenario, and in fact it's probably easier if I show you the investment cash flow forecast versus the mortgage, paying off the mortgage forecast. So let's look at those together. So the purple dotted line is investing all the money, and the grey dotted line is paying off the mortgage. Well, on paper it would seem that over time making the investments would be in your favour. That is true, but it comes with risk. So I think for most people in their situation, I would say pay off the mortgage, because it means that you've got guaranteed security, somewhere to live for the rest of your life, and you can clearly see there's not a huge amount of difference in the long term. What's important is to make that money work hard for you over the long term. Now, I should say that when we go through this with a real life client, we look at a variety of different catastrophe scenarios and look at what happens if the stock market crashes or investments don't grow quite as fast as you would like. I'm not going to do that now, but I think what you'll have seen is how we can look at different alternative scenarios in an inheritance situation to work for your benefit. So let's just summarise by reminding you that there's much more information on our website, and please feel free to contact us if you're interested in talking about your inheritance.